Good afternoon, faithful forethoughters. It's been a long time since we've had a live webinar. Welcome. This is something, Jake, we did weekly during the COVID crisis. And by the looks of the number of people that signed up, people missed it. How about that? So anyway,
Yeah,
my name is Scott Pinkerton, managing member at FourThought, and my profession is financial planning and investment management. And joining me today is our head analyst, Jake MacFarlane. Jake has been with us for how many years now, Jake?
Yeah, coming up on 6 years.
6 years. And this year, Jake is now a CFA, which is quite a difficult thing to get. And it's been extremely helpful for us at FourThought. The reason why we're having this special webinar is to talk about what's going on with the tariffs. There have been several times in my career. I started actually the week of October 87 when we had a 30% decline in a single day. That would be like a 20,000 point decline today. Welcome back, Kelly.
Thanks.
Kelly, our marketing person, has set this all up, and she wanted to make sure that she can join us. Anyway. It was a 20,000 point drop. And then, of course, we had the savings and loan crisis. And then we had the financial crisis and the technology crisis, the Asian currency crisis. The technology crisis was particularly bad. And then we had the global financial crisis and COVID. And when these things happen, I don't care how many times I've been through it, it is downright nerve-wracking. And the nature of these crises are that this time it's different. There's something unique happening today that's different than all other times that really give people concern. So today, that concern is tariffs. And what do we think about them? What could be the impact? What are we doing about them? So that's going to be our start today. Let's go on our next slide, Jake, where we have our disclosures. And basically, these are no recommendations for anything particular for you to do. But if you have concerns, obviously contact your FourThought planner. This is our bios, so you can see Scott and Jake. If you'd like a copy of these slides, give us a call. Your advisor or send us an email, or your advisor would be happy to send these to you. So here's our agenda. And Jake gave me a cheat sheet to talk about, what I'm supposed to talk about, what he's supposed to talk about. So let me walk you through what we're going to talk about first, and then I'll turn it over to Jake. First, the objective is to give you clarity on some of the recent headlines and how we're thinking about them. We're going to try to give you a context for these issues in light of long-term planning, financial planning, and investment planning, and give you our perspective of things that we're doing now already and things that we would recommend clients to do. We're going to start by going over what is a tariff, Tariff 101. Then we're going to talk about where are we, what's going on in the economy and in the financial markets that are causing such concern, what's going on. Then we're going to get back to some key investment principles that we've had and held and continue to hold. And then we'll look at the current outlook on the economy and what our outlook is on investment markets. And we do have some strong recommendations. And then what is FourThought doing specifically to meet your cash goals, your income goals, and your growth goals? Jake, anything you'd like to add to that?
No, I think it's a great opportunity too for our clients to ask questions as well. And so there's a Q&A function that's on your toolbar there. And if you click that or the chat, we'll be monitoring both. And if you have any questions that are kind of general thoughts, maybe we need to dive into something a little bit further or something we didn't hit on, we'll just encourage you to use that Q&A function and we'll be seeing that and monitoring it as we go on.
So let's start with the basics. What is a tariff, Jake? Who pays it, and what does it mean for the buyer, the seller, and the economy?
That's a great question. And to break it down, what we did is provided a little bit of an example here. Basically, if we take an exporter from a foreign country, and in this example, it's from First Trust, they used a Chinese exporter. And they create some sort of good that they're going to export over to a US-based company. Say it's a pair of jeans that go for $10. They're going to sell it for $10 to the importer. And the US government imposes a 10% tariff. That means that the US importer will have to pay $11, the $10 to the Chinese exporter and $1 to the US government. And then they will basically tack on their expenses and, a profit margin as well, and sell those jeans to the US consumer. There are a couple parties who theoretically can kind of handle this excess cost, that $1 of tariff that's going to the US government. In some rare cases, like in theory, the Chinese exporter could potentially lower their goods if there's a substitute, maybe another country with a more favorable tariff policy that we have on them, if they're afraid that the US importer will go elsewhere. Also, the US importer, the firm or the company who's going to sell those jeans to the consumer, they could maybe lower their profit margin, and so that the end cost to the consumer is the same. But in practice, businesses like profits, they like to make money, and in the vast majority of cases, the US consumer will likely pay more for those jeans. And that's kind of how tariffs are instituted and how it kind of flows through, and who ultimately bears those costs. Typically, it's a tax on the US consumer.
Yeah, I was listening to a report from a young woman who has a business in Minnesota where they make these devices for babies that go on to it's like a clean plate type of thing. And she said that when they were thinking about a 10% tariff, well, they have profit margins to absorb it, so they were not going to price it. And they've got a big contract with Walmart and Target, so they've got to deliver these products. And if it does get to be like, what is it, 125% tariff against Chinese goods now,
Right.
would somebody, would the consumer be willing to buy a product that today costs $30 and tomorrow costs $70? Even if they threw away their profit, it isn't going to happen. So they're clearly going to be some disjointedness happening. So one, if corporations reduce their profit, that's not good for corporate earnings. That will hurt. And if people don't buy products, it just slows the momentum of money, and that slows the economy, which isn't a great thing. So the key thing to remember is that in a tariff war, nobody wins. It slows down the world economy. And this is an example of the average tariff rates. Jake, you want to walk us through that?
Absolutely, yeah. The average U.S. Tariff rate going all the way back to the 1700s. But yeah, this chart here, right? You could look at it and say, well, yeah, I mean, the U.S. Tariff rate should be higher. I mean, it used to be way higher, upwards of 50%, and now it's a measly 2%. And we have to take this into context, right? Like the world economy today looks vastly different than in the 17, 18, and even 1900s. There has been shifts in economic policy towards free trade, globalization, and the last time that we really have seen tariffs spike upwards of 20% actually comes in like the 1930s from the Smoot-Hawley Tariff Act. And where basically the U.S. raised tariffs on over 20,000 imported goods. And the result of that was that global trade plunged by 65% between 1929 and 1934. We saw economic activity worsen, deepening the Great Depression. And so if you were to ask, 100 different economists, just like 100 different dietitians, right? There's many different ways that they would argue, dietitians or nutritionists would argue, you can make a good diet work. And there's a lot of nuance there. But I would reckon that all 100 nutritionists would agree that taking in a large amount of refined sugar is generally pretty bad. And the same kind of goes for economists, that they would kind of all agree that widespread tariffs are not really a good thing for economic prosperity.
So when you go back to prior to the 1900s, 1915 is when we implemented the first income tax. And so obviously when we took the income tax, we got rid of the tariffs, which created more global trade. But clearly that was a major cause of the global depression. So the next slide shows us about the current fairness of the tariffs that we're being charged. And what it shows, Jake, is that some of our large trading partners have higher tariffs, generally speaking, on their goods, on our goods coming to their country. Do you want to elaborate?
Yeah, absolutely. This is the average tariff rate that each country has, not just with the U.S., but just like in general. And so we're definitely on the very, very low end. And there are, the lowest of our top 10 trading partners. And even in like developed countries like Canada and Japan, our tariff rates are lower versus theirs. But it's not exactly just a fair thing to compare, our tariff rates versus maybe more developing countries like Brazil and India, because tariffs can work when they are, really directed towards maybe protecting an industry that is developing and leading a developing country to kind of become more developed. And so oftentimes you'll see countries do that maybe on a temporary basis or for one, specific sector or asset class that they're trying to develop. Whereas right now, for the U.S., we are already, the most developed country out there. Now, that's not to say that all things are fair, because even with the European Union, some other places that have much higher tariffs than we have in the U.S., we'll get into some different outcomes and scenarios, but a lot of this is potentially just negotiating more fair trade policies, which do look a little bit out of balance right now.
So we've gotten 2 tariffs imposed or proposed to be imposed. One is a 10% across the board tariff for any imported goods, and they've got specific country tariffs. So if we start at 10% across the board tariff, that's basically a tax to the consumer. It's either going to reduce corporate profits globally, or it's going to increase taxes domestically, one or the other, and it'd be a combination of both. The other thing I'd like to point out is that tariffs aren't just the only story. So you have things like the European Union taxing our big technology companies in some would say an unfair way, different other trade type of restrictions. So it's more complex. And this is the beginning salvo. So the next slide talks about, Jake, what's happened in the market. So we had this announcement of these really stiff tariffs. There was no exception. And when that announcement happened, what happened to the stock market?
But yeah, that's really when we start to see a pretty substantial dip. In fact, the stock market was pretty positive on the new administration, maybe some kind of momentum from Department of Government Efficiency program, and kind of entered the years near all-time highs and actually expanded on that, hitting all-time highs towards the kind of middle of February at over 6,100 for the S&P 500. And then we got basically a 20% correction there, all the way down under 5,000 for the S&P. And that was not only did the tariff policy start to become a little bit more clear, like, okay, this is a real thing that's happening. I think the 10% tariff kind of got out there. But then these reciprocal tariffs came out, and they were a lot worse than even like some analysts who were making these projections. Like even their worst case projections, these reciprocal tariffs exceeded those. And so that's when we really saw kind of a downturn that was, sort of steady downward to that large drop that was seen at the end of that arrow there.
And people were starting to realize that this is real. It's going to happen. And there was some stridency in the Trump camp, Trump White House saying that this is going to be the way it's going to be. Then you see a big rebound. In a single day, the market was, it was down, close to 12% in a single day, down 20%, the S&P 500, and then it springs back up 9% in an afternoon. Jake?
Right. I mean, that's just the reality of it. And we'll talk about like what actually drives a stock price on a day-to-day basis. But in that one day, I mean, these are like record-breaking days, and volatility was spiking. And this quick rebound was kind of like, hey, we're taking a pause. Maybe profits will be better than what we sort of initially feared might happen to them. And at the same time, we are still about 13% off of the all-time highs hit in February. So
it
while
was
some
all
of that,
about Trump. Yeah, it was all about
yeah,
Trump delaying the tariffs. And as soon as that happened, the market rebounded. But you're right, it's still down quite a bit. Now look at the next slide, Jake. This is the treasuries. And we were talking about this morning. So the treasury yield, that just doesn't move that much. And this is a massive market. And so when you see the treasury, and people are worried about the treasury auction, when you see the treasury move like that, there's some big buying and selling that goes into play. Now, most of the treasuries that are outstanding are owned by U.S. entities, clearly like 80, 90%, 80%. Japan is our largest external owner of treasuries, and then China. And then, of course, there's a whole host of other folks. We're the global the global currency, so to speak, and this is the safe haven. So when you saw interest rates on the 10-year treasury jump from 4 to 4.5% in over a 2-day period, I don't remember in my 37-year career that ever happening. And that was a thunderstrike to Washington. My belief is that's the thing that caused Trump to come out and say, hey, we got to pause this. If we lose control of our interest rates, imagine the interest on the debt, for example. It would just be a catastrophe. And so by quickly saying, hey, we're going to pause on this, it tells the world that this is not the stridency that we're hearing. This is a negotiation, and the negotiations are starting now. And then we saw the treasury yields come back down. If you see treasury yields dropping, it's anticipation of the Federal Reserve lowering interest rates. This morning, you heard overnight where Trump was bashing Powell. He's got a new nickname for him, calling him Too Late Powell, because in 2019, most economists agree with Trump that Powell was too late in lowering interest rates. Was it in 2019? Yeah. And it caused a bear market. Of course, that quickly changed, and the market was off to the races after that. But what we saw last week was the precarious, the dollar and the treasuries are fragile now. And if we lower interest rates too soon, that could create a flood of dollars, and it could actually exacerbate the problem by raising government interest rates. So the next slide, Jake, is going to be about consumer and investor confidence. And what we're seeing here is some real concern. So why don't you share the graph with us?
Yeah, absolutely. I mean, if we look at the kind of the average, this is a long-term average of 84 for the investor sentiment index done by the University of Michigan. And we recently had the kind of end of March print just a few weeks ago that came in at 50.8. And just putting that into perspective, that's almost the same level that we sort of had and not even during COVID, but actually when the market was down in a bear market in 2022. In fact, the sentiment index is much lower than we even got during COVID. And it's actually lower than we saw even back in 2008 during the great financial crisis. So investor sentiment, very, very low. I think a lot of concern over tariffs, but also the impact on kind of forward-looking inflation as well.
So let's switch gears and talk about how do we think about this. So investors are negative. The market, I think Trump used the term getting yippy, like a dog. And we're seeing people start to panic. One thing I would point out, though, is that the panic this time was a single day panic. So if you're working, you probably didn't even know what happened. And you turn on the news and you see this huge drop. But if you're in it, it's like I had a client meeting. I look at the market and I come out of the client meeting going, oh my gosh, what occurred? So anyway, we have had this construct, this mental construct that's helped us navigate crises like the COVID crisis. When we kind of invented it, we call it our street signs. And the idea is that imagine that you are your spouse, partner, whatever says, hey, I want to go on a special trip. Pack your bags, and you don't know where you're going. So you leave Venice and suddenly you turn north. So suddenly you're seeing the street signs that you're heading to Tampa. There's a whole host of places you could be going. Next thing you know, you see a sign for Orlando, and you just gradually narrow and narrow where you're going to end up. That's the way it is with predicting. What we do is go back to a book called Super Predictors by Adam Tetlock, and they have this group called DARPA, where they reviewed literally thousands of teams and their ability to predict. And what they found is that sound thinkers, the best investors, the best predictors, frankly, are the ones that don't try to predict. They establish a base case, and then they have street signs along the way to tell them which direction they're going, and then they adjust their base case. So in the beginning of the year, we had down 3 big concerns, and then others, obviously. And our original base case was we weren't expecting a huge market move. January 28th, the market was measured by the S&P was at 6,070, and our base cases was thinking it could be as high as 6,400 by the end of the year. The concerns that we had were Trump 2.0. Number one was tariffs, which could be a negative influence, deregulation, which could be a positive influence, and then you have immigration, which is more complex. Obviously, tariffs are dwarfing everything. Now, when we look back on this in history, will it dwarf everything? We don't know. But let's spend a few moments, Jake, and walk through kind of our base case today. But let's start with kind of the worst case scenario, and then we'll go to a hard landing, or what we would call a bad case, base case, better case, and best case.
Yeah, so Scott, if I may, just real quick before I hand it back to you on the next slide, is one thing just to point out that we did this year is we actually left the key driver number 1 and number 2 blank, because we know that at some point this year there's some risk in the market, and it could even be a beneficial part of or a beneficial driver to stock returns that nobody's talking about right now. And this some sort of exogenous event here that we know every year happens. And so Trump 2.0 is definitely our number 1 risk, but there are also items that can come throughout the year that nobody's even looking at right now. But based on the information that we have today, based on the data that we get every month, every quarter, et cetera, Scott, why don't you walk us through kind of the different scenarios that we see, kind of the good, bad, the ugly. Maybe start with kind of the worst case scenario.
Let's start with the base case. So when you think probabilistically, you have to think, okay, what could happen? And then what's the probability of that happening? What's our confidence level? So we know that there are unfair trade practices, and there are some unfair trade practices that we have that, of course, will be negotiated out. We know that Trump is concerned about the midterm elections, which are 2 years away. So we don't want, there's no motivation here to have this long, prolonged deal. As we make deals, it's highly probable that we will end up with better trade agreements than what we started with. That will be a positive. So our base case is this. Our base case is that we have some resolution to many of the major trading partners, especially the European Union, Brazil, Mexico, Canada, et cetera, but probably not completely China, but we're not in an all-out trade war with China. Negotiations are taking place. That the economy avoids a recession, and that through those trade changes, and they happen fast enough so that we don't tip into a recession. Timing of this is going to be critical. If investor sentiment is so negative, they're going to stop spending. We're seeing some hoarding taking place. We're seeing people accelerate their purchases. That's going to slow the economy down. Is that stopping and slowing of the economy going to be lifted in time or not? That's the question. Our base case is that it will be, and we think that that's probably about a 50% probability. If, however, we go to the bad case, a situation there would be we get some resolution, but the trade war with China is persistent, and we don't get all the resolution we want, and things take a lot longer than expected. How this could happen, for example, is we could see other countries getting together and establishing more of a hard stance against us, and we're not able to isolate. Don't know if that's going to happen, but that's certainly a possibility. And it drags out longer so that we do tip into recession, but it isn't an all-out, long-term war. The worst case scenario is that we have a new global order. For the last 30 years, we've had this wind at our back called lower inflation and free trade, basically globalization. And as you've heard ad nauseum, this helped overall, but it certainly hurt certain types of jobs in certain communities, certain people. But overall, the Walmartization, so to speak, was a net benefit. If that gets reversed and it's permanently displaced, and we end up more isolated with less productivity, higher costs of goods and services, that's gonna reduce our standard of living. It'll reduce the optimism. You'll have a kind of a negative spiral that you'll see. That would be kind of the worst case scenario. It's in nobody's interest to see that, but I would remind people that the history is chock full of things that happened that weren't in people's interest. I just remind you of World War I with Prince Ferdinand, the Duke Ferdinand, right? Who would have thought that single event would have escalated into the world war that it did? So these things can happen, but we think it's a very low probability. But it doesn't mean just because it's a low probability, you still have to be prepared for that low probability. Now, questions, comments, Jake, would you add anything to that?
No, I think it's a great point. I mean, if we think about a stagflation environment, right? That's where inflation is still high and a lot of times still creeping up, but we've got no growth. And that's just a really tough scenario to be in. Yeah. And it's one that, like, if there's still a lot of uncertainty with the tariff policies, I mean, to your point, like at some point, businesses, when they have this uncertainty about input pricing and things like that, just makes them much more likely to like hesitate and just flat out stop on new investments, new, plant property, equipment, all these things. And that can really slow down production here.
Yeah, stagflation is when you have a higher cost inflation and you have high unemployment. And that's when you have a slow economy with inflation, which isn't supposed to happen. But if you push up the cost of goods and services, that's what could occur. It occurred in the 70s. But we don't think it's likely. A more likely scenario is the base case and then the better case. The better case is that we have not just positive resolutions to these trade concerns, but not only resolutions, but positive resolutions. And we see more fairness. And in fact, we end up at a place where we have freer and fairer trade. We got to be careful of getting into this habit of having exemption here, exemption there. That is a pathway to corruption. What we need to have is just across the board. A businessman doesn't have to worry about, I got to go lobby Washington to get my special exemption and ask for it. We want to have just free trade across the board, fair trade across the board. That is a possibility. And if that occurs, even if China is not completely on board, then we will have a very positive outcome. The best case scenario, which we think is unlikely, but probably more likely than the worst case scenario, but not much more. And that is that we get, all cards are played and we win masterfully, including intellectual property rights in China. One thing that is so aggravating to American businesses is that once you're in China for a certain amount of time, you have to give up your intellectual property, and that's like a non-starter. And some companies have dealt with it, but if we can get that and stop the espionage, stop the trade secrets, et cetera, that could be a huge positive. But we don't think that that's a likely outcome. So, Jake, as we get into this issue, and it seems like these are some really major things that have changed. How does that look when you take a step back and look at some of the basic fundamentals as far as the market's performance over time and what it means to investors?
Right. Well, this is actually, yeah. Go ahead, Scott.
Any questions? Don't hesitate to put them into Q&A. I'm watching those.
Awesome. Yeah, this is one of my favorite charts here. Just really helps you take a step back. And what this is doing is kind of the bigger graph here is the world stock market performance over the last 12 months with some headlines that have kind of driven the market in the short term. And so what we can see is that from kind of the end of Q1 this year, March, going back to the end of Q1 last year, right, over that 12-month period, the market is actually up a little bit, not by much, but the headlines have been oh so volatile. I mean, there's been ups and there's been downs, but what I find is often so helpful is that if you zoom out and look at this over the long term, and so this is the chart down here that looks at from all the way back to 2000, Q1 of 2000. We can see that even in these dips, like we have in a little dip right now, which feels terrible. We had another dip during 2022 in the bear market. We had one during COVID, and then the great financial crisis too, back in 2008. But you can still see that over the long term, the market has quadrupled over that time frame, even with all that volatility. And so I think it really gets back to the main point of like why we invest, right? We invest and we take on a little bit of risk to experience markets like we're in right now, because we know that if we just hold all of our money in cash, that we won't really meet any of our financial goals. A lot of it could be retirement or education planning or leaving some sort of inheritance. You know, we would have to work basically until we die, but along the way there, our purchasing power that's in cash is going to be dwindled down each year by the inflation rate. And so I think it's all just, you know, so important, even through all the daily volatility and all the headlines, to take kind of a longer term view and see, you know, why we invest in the first place.
And go over, Jake, the basics of what drives a stock, because this has an impact on what our recommendations are going to be.
Absolutely. So when we look here, let me see if I can get this annotation out of the way. But what makes stocks go up and go down, right? That's a great question. And the answer is actually really simple. It all has to do with profits. When profits go up, prices tend to increase. When profits fall, prices tend to go down. The caveat that I would add to this is that the market is forward-looking, which is why oftentimes, like a lot of investors can be really confused about, like when a stock has, you know, an earnings report and the last quarter they beat their expectation and their guidance, but the stock's down. Like, well, what's up with that? And it's because the market's forward-looking, and so really prices move a lot more about expectations of future profits, which is so important. And I think when we move into an example of this, one second here. When we look at like the S&P 500, let's just say over time versus the earnings per share of the market, we see that in the orange is the price level of the market, the stock market. And in the blue is earnings expectations for the next 12 months. And this goes all the way back to 2000. And you can see this positive relationship that's at play, where broadly speaking, as you know, earnings expectations are going up, the stock market's going up. And then you can really see it in periods of downturns. That blue line, you know, trends downwards. You know, earnings growth for the next year is not looking so hot, and the market falls, right? And so again, like when we tie it back to what's happened this year, where the market is down right now, earnings expectations haven't changed. You know, it's been too quick to try to assume what the tariff policy or trade stance is going to actually do to corporate earnings over the next 12 months. So the price right now of the market, that drawdown, hasn't really followed earnings. And so that's why we're really paying attention to how earnings shape up over the next year.
So what we're seeing, like United Airlines this week gave 2 earnings projections. One, if tariffs subside and go away quickly, and one if they don't. And also point out that the stock prices move before earnings. People are anticipating the earnings declines. And we haven't seen those earnings declines show up in the market yet because they haven't happened yet. But we're going to see earnings pop because of the spending that people have done in advance. And then if they don't fix it quick, earnings will drop off. And so this market decline, I don't want you to hear that it's over and we're off to the races. We could have another leg down, and it wouldn't surprise me a bit. And that would be as people start to calculate the impact of tariffs on corporate earnings, it'll revalue everything. And if they think it's sticky, then the overall psychology that Jake was just talking about could turn negative. And is there any reason why in 1 year people are willing to pay 30, 25 times earnings for the American economy versus the next year 18 times? It's all psychology. And we want to make sure that we don't tip that psychology too negative. The next slide talks about really drawdowns, Jake. And it talks about big negative drawdowns and what happens.
Right. And again, this is looking over the long term, and each line that you see, either yellow, orange, or red, is some sort of drawdown in the market. The yellow, which happens most frequently, is just a 5% drawdown. The orange being a 10%, and the red being 20% correction. And what we see here is that these losses happen, and they're actually normal, even in a healthy market environment. And how it kind of shakes out, if you do the math on average, there is about a 10% drawdown on average every 12 months. And this even happens like in a positive market, like last year or the year prior. S&P was up well over 15%, but we still had intra-year declines right around 10% there.
And that's why you make more money in stocks, because you got to stomach the volatility.
Yeah, absolutely. And even in a more severe, like a 20% down, it tends to happen on average every 3 to 4 years. So, not that far apart. And then even a 30% correction or worse tends to happen on average once every decade, right? So these losses happen, the drawdowns happen, but over the long term, right? The blue line shows basically the value of $1 invested in U.S. stocks since 1926. That one singular dollar over that period to the end of 2023 has actually grown to over $16,000, right? And so that is, the reason why you stomach this risk and why you invest.
The other thing I'd point out, Jake, before we move on to the next slide, is notice the rapid number of red lines that we're seeing. There should be another red line because it just happened. We had another 20% decline. So we were having, a 20% decline once every 7 years, and we've had 4 in the last 7 years. So it's we've had a pretty volatile market for various reasons. The next slide is really interesting, and it's complicated, but let me kind of walk you through the two of them. On the left-hand side, there's this thing called the VIX. It goes back to 1990, and it's a measure of volatility in the market. And this is a measurement of every time the VIX hit 50 or more. So for the last couple of years, it's been hanging around 12, right? But it's had 75 spikes going back to 2000 or 2000 and 20 years or so. They've had 75 spikes of over 50%, which just happened on 4/8/25. So last week, of those 75 times when the VIX hit 50, when the market collapsed, basically, either had a meltdown or a melt up, 75 out of 75 times, the market 12 months later was higher. So there's this thing in investing called capitulation. You've got a bunch of people with stocks, and you got people that don't know why they own a company. They don't understand it. And when things get shaken, they panic. And that's what we saw. My interesting thinking about this, Jake, and we haven't talked a lot about it, is I don't think we had true capitulation last week. Yeah, the VIX spiked, and that's a good thing. And perhaps this will be 76 out of 76 times. Likely it will be, right? But I don't think the average investor panicked because the average investor didn't know what was going on. The average investor isn't glued to their computers that much. So what'll take place is when you have the 401k investors start to panic. This is the the forward returns after the largest 4-day declines. And this decline going back to, gosh, 87 is the 12th biggest decline that we've had. And you can see again, looking forward a year, 2, 3 years, 5 years, the market's always been positive, and not just positive, but substantially positive. So, this is a signal, I think. Usually there's news and there's noise. This is news. This kind of volatility typically leads to pretty consistent, strong results. Next. So, Jake, let's talk a little about the length of bear markets and some of the dangers of panicking.
Right. I think another great slide here where we see bull markets, which are in blue, and bear markets, which are in red. And it's measured on both, percentage gain or loss during that market, and also the amount of months that kind of comprise those markets. And what you can see just by glancing at the chart is that those red blurps are disproportionately smaller than the blue. In other words, bull markets tend to last a lot longer, and they tend to provide a much higher kind of absolute number of return than, you see on the downside for bear markets. A lot of that is because the stock market can go up infinitely, right, over long periods of time, whereas to the downside, you can only go down 100%. But also, if you try to just plan around missing those red blurbs, especially when you have a time horizon that's long, or even if you're like a conservative investor and your time horizon isn't super long, but you're in more defensive stocks, trying to plan around and time the market to avoid those red blurbs means that you will inevitably miss out on a good bit of those blue bull markets as well, which can have really detrimental effects on long-term returns.
There's 3 ways that I've seen people fail at retirement once they have a plan set up. One is they have all their eggs in one basket. They love Cracker Barrel, and so they put everything in the Cracker Barrel. 2 is they don't have proper alignment with their spending needs and their assets. So they have short-term needs, and they've got long-term assets to cover those needs. Then you have a short-term correction in the long-term asset, and you need the money, you have to sell it low. The final way I've seen people mess up their retirement is by panicking when things go down. So this is a strong endorsement of not panicking. We have a couple questions, Jake. One came from CB. I wonder if that's a CB trucker. Basically saying, we've had a falling interest rate environment for 40 years. Do you see a difference now for stocks? And the answer is absolutely yes. Einstein said that insanity is doing the same thing and expecting different results. I would add to that insanity can also be doing the same thing in a different environment and expecting the same results. So we have had a long-term bull market for bonds as interest rates, when I started in the industry, 1987, 10-year treasuries were at 15 and they got all the way down to 0. And now they're back up to 4. Is that going to be a different environment? Absolutely will be. And it's kind of like you're on one of those escalators, and it's like a moving sidewalk. You get on the moving sidewalk and you go really fast. You say, "Man, I'm in good shape." Well, you're not in that great of shape. You had a lot of wind at your back, and that moving sidewalk isn't happening anymore. So I do think that it is it's highly probable that we will not have the kind of long-term high returns in those risk assets, especially after you see inflation. But on the other hand, you have another thing that we haven't seen before is the impact of AI and the productivity enhancements. So those could be an offset. I hate to isolate one thing and say this is going to be cause this, because there's too many ingredients in the soup to do that. The other question was, read an article on CNBC this morning endorsing the idea of purchasing Netflix now before the earnings come out. Does that seem like it makes sense? And the answer is no, it doesn't make sense. However, what we're doing is we're seeing great companies, and this is the key to remember about investing with forethought, is we don't invest on speculative ideas. We don't invest in stories. Jake does a ton of work to look for companies that are consistently growing their cash flow, their earnings, so that in any kind of environment, you can expect to make more this year than they did last year. Now, some companies will reinvest and they'll grow. So we're buying companies like NVIDIA and Broadcom, which have got great futures with what's going on with AI. And we're also buying quality companies like Florida Power and Light that have consistent cash flow. So, when you see declines like this, what we're looking to do is to take an opportunity to take some profits in one spot and buy some of those opportunities when they're down. So let's get into some of the economics, Jake. The first thing we wanted to look at is GDP. I tell you, GDP looks pretty darn good, right? We've got pretty consistent 2.5%, 3% GDP. That's going to change if these tariffs stick. But our GDP is much stronger than any of the other folks we've gone to quote unquote trade war against, especially China. So we have the strength perhaps to win this war, but it's going to be where you have two people shoot each other and great, the one guy dies later. It doesn't really matter. Nobody wins a trade war. But GDP is looking pretty strong. Jake, any comments you'd want to make that?
Yeah, just real quick, pointing out where our GDP comes from, and 2/3, actually more than 2/3, 68% of it comes from consumption. We've talked about that the U.S. is a consumption-based economy many a times, and one area where we do see some risk still is actually with the U.S. consumer. And so looking at the consumer balance sheet on the left-hand side, that looks like it's in great shape, and a lot of that's driven by financial assets like 401ks, which even though they're down this year, have still kind of ridden the wave upward over the last 5 or so years of really strong market gains. But also home equity too, now at 27% of total assets. This disproportionately is showing kind of like the baby boomer effect, right, of consumers that are in really good shape. Whereas with kind of the younger generations, maybe that don't own a home yet, or they're in the early stages, right, and still have more in mortgages than they have, ownership in their home, right? We're seeing that segment of the population show some signs of weakness in both debt service ratio, which is now kind of creeping up past 10%. It's kind of getting back to kind of a pre-COVID norm. And so we're going to be focused on if that starts to level out or not, but also flows into early delinquencies. This, I think, is a little bit more alarming because the numbers for auto loans and credit cards have actually crept past those like pre-COVID norms, and they're kind of getting up to where they were back in the 2007, 2008 levels there. So we're worried that if prices increase due to tariffs, the wallet share of consumers, a lot of that is going to dissipate, and what's left over for like discretionary spending will become less and less, which is what we're worried about. And the consumer can only rack up so much credit card debt before they have to just pull back. And that's one thing that we're a little bit worried about looking at kind of the future prosperity here of GDP.
Yeah, the Dollar General population is getting hammered. The next slide talks about inflation, which was the nemesis and has been our nemesis. You can see it peaked in 2022 at 9%, and it has been kind of on a decline. You'll notice that energy prices went down. So that was actually, it went, the year over year, it went down a lot. And so that lowered inflation. But you'll notice the dark blue, which is shelter costs. So shelter costs are rents, owner's equivalent rents, which we've talked about in the past. And of course, home prices have remained stubbornly high, and even apartment rent. So you're seeing multifamily housing projects, all over the place. And yet when you look at the rents, they're starting to come down, but not as much as you would think. What's happening is facilities are saying, yeah, well, we'll give you 1 or 2 months free so they don't have to show lower rent. But those numbers are kind of embedded. You see lower oil prices as well. So we're going to see inflation, if we hadn't had this trade war, continue to go down. And that's a good thing. It would allow the Federal Reserve to obviously lower interest rates. Now, if this trade war is quickly resolved, I don't think there's any reason that we would see a huge uptick in inflation. But if the cost of goods and services go up and we have less workers to do the work, and wages go up, which is a good thing in some ways, but it would cause inflation to come back. So inflation has been a net positive for our economy. Next, you see unemployment. And the bottom line is that we're seeing unemployment remain low. And the question is, how long will companies, stay at full employment if they, if things are starting to slow down? So there'll be certain displacements that happen from importers, et cetera. And it'll take a while to pick up on the manufacturing side. So that'll be complex, but you see unemployment and wages. And for the first time, and probably we go back, this slide goes back to 1980, we've seen wages grow faster than inflation and higher than the unemployment rate, which is it's a hugely positive thing. Next, we have the Fed. So Jake, you want to kind of walk us through this? This is really critical.
Absolutely. One thing we always like to do here is look at the market expectation versus what the Fed is projecting. And so the FOMC year-end estimates, that's going to be in like your navy blue, and the market expectation is going to be in that like teal green color. And so from where we're at today, both the market and the Federal Reserve are aligned, and they're thinking that at year-end next year, we'll be lower. I'm sorry, at the end of this year, we'll be the rate will be lower than it is today at 4.38%. The Fed expects us to drop to 3.9%, call it 2 cuts. Whereas the market expectation is more like 3 or 4 cuts down to 3.6%. But then the market expects that to kind of flatten out over the next 2 years. Maybe we get 1 additional cut in 2026, but that's it. And that's where the Fed right now is actually projecting a little bit different, whereas they expect to cut maybe 2 more times the following year, maybe 2 more times the next year to get us down to their long run projection of 3% interest rates. And so what the market might be telling us is that, hey, this tariff thing, if it gets real, the Fed might have to lower rates. I mean, inflation's coming down. There could be a case where unemployment starts to rise if businesses are really concerned about the future. And so that would, in all likelihood, cause the Fed to kind of stop their neutral stance and maybe bring rates lower, down faster. But then, one way of reading this is they might be expecting inflation to start to rear its head again, and the Fed have to take their foot off the gas there. Whereas the Fed's kind of not seeing that in the data yet, of course. And so they're kind of still on their same path that they've kind of hinted at over the last couple of quarters.
Well, and this time it's different scenario is that you could have a currency crisis where the economy slows and yet the dollar gets weaker and the bond yields go up. And so the Fed is going to have a hard time cutting interest rates when they can't sell their bonds. So then you're going to have pressure on the Treasury to go back into quantitative easing, which is where they print money to buy bonds to drive rates lower. That's a game of chicken. And that would really disrupt the markets. Again, that's kind of a worst case scenario that we don't think is going to happen, but we're watching it for you. By the way, Jake, I'm looking at who's listening. Sam Meyer, our former intern and one-time employee, is listening. I think he's in the Peace Corps down in, where are you, Sam? Type it into the Zoom. I'd be curious about where you're at now. Maybe you're out of the Peace Corps now. We'll see. Anyway, next slide, Jake, gets into the concentration levels. I think you love this slide. Oh, I'm sorry, it's stock market valuations. So I'll do this and you'll do the concentration levels. When the market dropped, suddenly valuations became much more reasonable. Stocks that were overvalued, particularly these Mag 7 that we'll talk about in just a second, they particularly got hit. So that's great. If earnings continue to stay where they're at, big if, then suddenly the stock market is not expensive anymore. So you've seen a dramatic decline with the stock market. Jake, talk about those Mag 7s.
Absolutely. I mean, and what we're seeing here, just want to point it out, right? That red box is kind of drawing you to the Q1, right? So if we rewind the clocks back to the beginning of this year, as we're coming into 2025, the stock market was expensive, right? If we just look at, broadly speaking, the S&P 500 traded at 21.5 times earnings. The average is just over 16.5 times earnings, right? So 29% premium to the long-term average. And where we looked at like what stocks were driving that, you didn't have to look far. If you just looked at the top 10 holdings within the index, that's Apple, Nvidia, Microsoft, Amazon, these big tech companies, they were on average trading at 29.8 times earnings, almost 30 times earnings, which was a 45% premium to the long-term average of the top 10 in the S&P 500. Not only that, but the index was getting more and more concentrated. That's at the top right. The weight of the top 10 stocks in the index approached 40%, right? And so we saw that as a major risk. And in fact, kind of in our portfolios, we had lower exposure to those top 10 names. In fact, we outright didn't own a good bit of them. But even in the stocks, the businesses we did like, a lot of them we had at lower weights than the benchmark had because we didn't see a huge value proposition there. But now, if we look at where we're at today, right at the end of March 2025, we can see that the top 10 now have went from 30 times earnings down to 24 times earnings. And now just it's still a slight premium to the average, but just an 18% premium versus if we look at the remaining 490 stocks, they're at just about the same premium to the long-term average. So basically where we saw valuations come down came from those big tech companies, particularly, those top 10 names, and also their concentration within the S&P 500 came down from about 40% to about 35%. Those are major moves to happen in just one quarter time.
Our friend Paul asked a question, what about consumer credit card debt? That hit spiking as well. And so you're seeing the Dollar General, the most vulnerable part of our society and economy starting to show real problems, which is unusual when you have this low of unemployment because people are working. It's a sign of how much inflation is really taking place in the consumer. The other thing I'd point out is that slide, Jake, is at the end of the second quarter. And of course, we had all the volatility and another 13% down leg since that point. So it's gotten more attractive. The other thing I'd comment is there's a big difference between Amazon and NVIDIA, which are part of the Mag 7, and Tesla and Netflix. Just in valuations and pricing and PE multiples, NVIDIA and Amazon are real businesses. And they're not trading that expensive. I think NVIDIA is dipping down to 20 times future earnings, which, for a company that's projected to grow at 40% a year is pretty darn cheap, actually. So that's why you're seeing us nibble at these companies still. The last slide we want to share with you is consumer or source of earnings and growth and profit margins. So why don't you take this, Jake, and I'll wrap it up afterwards.
Yeah, happy to. And again, this is where things get interesting, right? As we talk about how prices often, trend with earnings growth. And what analysts are still expecting for 2025, as well as the next 2 years, are for earnings growth in the S&P 500 to eclipse 10% in each year. And if you go through the chart, which goes all the way back to the early 2000s, that's rarely happened. I mean, it's happened once kind of leading into 2008, we saw that. But you don't often get a stretch of, it would actually be 4 years in a row of 10+% earnings growth. And so we're being very cognizant of that. One way that you can get earnings growth is, if you have top line growth, revenue growth with the same margin, right? That's going to lead to profit growth. The other way to get there is, if you have similar revenue, but you're able to expand your profit margin, well, then you'll have more dollars in earnings left over. So where we have seen profit margins trend really since the GFC is upward. But we're kind of at the top end of that range at 13% profit margins, only to be eclipsed by, around 14% back in 2021. And if we start to see some pressure here on costs, we could likely see a scenario where either margins have to come down or maybe revenue has to come down because the volume isn't as high. So these are numbers that we're paying very close attention to. Our base case says that these might be slightly lofty, but also not completely break down. And at that point, it's not a bad time to be buyers of great companies that are trading at intrinsic discounts to fair value. But also it's one that there is a lot of uncertainty around.
So Jake, where do you think Sam's at right now?
Oh, that's a great question. I feel
like
Albania. Oh, great. That's exactly what I was going to guess.
So let me wrap up by first thanking you for listening. This is, I guess, one last slide. It shows how investor, trying to time the market can be a real disaster. If you miss the best day in the market, your return drops from 10.6 to 10.26. If you miss the best, say 15 days, it drops down to 7.3. So as you see, what the market tends to take the elevator down and the elevator up. It doesn't take the elevator down and the stairs up. It happens quick. So you want to be careful not to be out, and trying to predict the bottom is a tough thing. So what are we doing? What should you do? I think the first thing is going back to our core principles. Understand point number one is that you're not God. We can't predict. You can't predict. We don't know which of those scenarios are going to happen. We have kind of our sense of probabilities. But if you start there and you think about, okay, what do I need to do to thrive and survive? Step one, the goose that lays the golden eggs. If you're a FourThought client, you can relax. If you've got growth stocks, it's because you have a time horizon that's appropriate for growth stocks. And we have to anticipate that those growth stocks are going to have these ups and downs. That's why you have the kind of rewards that you get. I mean, we're up 53% 2 years ago, 20+% the last 2 years. You don't get that without having some volatility. If you need the money tomorrow and you haven't invested in crypto or in stock, get it out, period. We always say, hey, if you need the money coming up over the next year, make sure it's in something like a bond or a CD or the money market. So if you've got growth, growth is your mindset. This is a gift. You're now having the opportunity to buy these great companies at a discounted price. If you need money and you don't have it, you need to get it, because this thing could take a leg down. We don't know, and you don't want to have to pull money out during that leg down. Income investing. That's the other reason you would invest. It's very important to us to talk to each client and map out their income stream. So we call this the goose that lays the golden eggs. So when you sit with your planner, and some of you aren't, needing income now, your planner sits down and says, okay, here's how much money you're going to need. Here's the bonds that are maturing to cover that need. And here's the dividends and interest from the stock so that you don't have to sell. And we were prepared for these kind of disruptions, right? Invest, don't speculate. This is not the time to try to pick the next meme stock. You've got an opportunity to buy great companies at a discounted price. So what we're doing for certain clients is we're starting to sell those safe assets as they hold their value, and the risk assets go down and rebalance that way. We don't have a big opportunity because so many stock profits have happened over the last couple of years. So be looking for yield as a critical part of it. The tortoise and the hare reminds us again, invest, don't speculate. And the final thing is be prepared for the flood. So we're always talking about this. Again, the book of Genesis, there's going to be events like this that nobody possibly could have predicted. And we don't know what the outcome is going to be. So game theory that out. Do you have the cash flow to set aside so that you can survive and thrive? So you don't have to sell, at the wrong time, and you don't panic. Your plans are set up for these very moments. We sacrifice yield on the upside to protect on the downside because these moments are going to happen. So we're here for you. This is the time when being a client of FourThought, is precious for us and it's precious for you because we've made the decision to invest in quality, to invest in companies that are going to be around, and to make sure that you're not leveraged and you're not taking undue risks. So with that, Jake, happy holidays, happy Easter or Passover or whatever it is that you're celebrating. Know that you're in our hearts, and don't hesitate to reach out. We're not too busy. We're not getting a bunch of panic calls. So if you want to talk to us, please call us, email us. We're happy to jump on a call and talk with you. God bless, and Remember, great planning requires forethought.